This is an Uncovered Japan company research report on Broadmind, ticker 7343. Broadmind is a small Tokyo financial advisory company with an unusually broad license stack. It can advise households on insurance, mortgages, securities, and property under one roof. That creates a differentiated service model, but the investment case also asks whether a premium valuation and two concentrated carrier relationships are justified. At the research date, Broadmind traded at roughly 21 times forward earnings, 1.67 times book value, and a 5.95% dividend yield. FY26 return on equity was 9.9%, while the equity ratio was 75.6%. So this is not a classic deep value multiple. Investors are being asked to pay for a stable core business, a high stated payout, and a balance sheet with substantial resilience. The product is not a fund or an app. It is a household financial advice relationship. Broadmind combines insurance, mortgages, securities, property, and inheritance-related advice through one advisor. Most Japanese distribution rivals specialize in just one silo. Broadmind says only 11 firms in Japan have assembled all 4 relevant registrations. It took the company 13 years to complete that stack, which makes the regulatory and operational combination more meaningful than a simple sales pitch. Broadmind has 2 segments, but they should not be weighted equally. Financial Partner represented 91% of fiscal year 26 sales and delivered a 12.5% operating margin. It is the advisory engine. The smaller real estate sales arm represented 9% of sales and earned a 4.8% margin. That arm develops apartment buildings and can shift a sale across the March year-end, making the reported group numbers look much more volatile than the core advisory operation. Revenue compounded at about 9.9% a year from FY22 through FY26, rising from 3.62 billion yen to 5.29 billion yen. The path was uneven. FY25 margins and net income fell sharply. Then FY26 operating profit recovered to 623 million yen despite lower revenue. The report attributes much of the apparent volatility to FY25 one-offs and real estate timing, while the financial partner operation improved its margin after the loss-making walk-in business was exited. Broadmind's defensibility has 3 layers. First is the full license stack. Second is roughly 20 years of consultation records and household financial profiles, which the company is using to develop an FP-specialized large language model. Third is vertical integration. It handles lead generation, meetings, financial planning, contracts, aftercare, and cross-sell in-house. Together, those choices help explain why the core financial partner margin reached 12.5%. The biggest risk is not hidden. MetLife accounted for 34.7% of FY26 sales, and Manulife for 16.9%. So the top 2 carriers together supplied 51.6% of consolidated revenue. Broadmind works with about 60 carriers, but that does not fully diversify the income statement. A change in commission terms or product policy at either major partner can move earnings directly. The counterweight is very high policy continuation rates, but concentration remains the key watch item. Reported cash flow needs the same 2-segment lens. FY26 operating cash flow was negative 468 million yen, largely because a property sale was deferred and inventory increased. The core advisory business itself is asset-light and cash generative. The property unit can pull cash flow and profit across reporting periods. That distinction matters when judging both balance sheet strength and the reliability of a headline cash flow number. Management's FY 2030 ambition is roughly 6.9 billion yen of revenue and a 16.5% operating margin. The plan rests on more consultants, higher productivity through AI, more stock-type commission revenue, and new B2B financial education income. The macro backdrop includes Japan's new NISA regime and greater emphasis on financial education. But the plan also faces near-term drag from a single premium commission restructuring and a practical challenge, retaining consultants while hiring expands. On valuation, Broadmind is not cheap. The forward PE is about 21 times, above the report's normalized historical average of roughly 15 times, and above the healthy listed peer ILIC at around 13 times. Some premium can be rational. Broadmind has a higher core margin, a stronger equity ratio, and a larger dividend yield. Still, the premium puts more weight on continued execution, especially on AI productivity and the transition towards stock-type revenue. The income case is the most distinctive part of the valuation. Broadmind's stated FY27 dividend is 70 yen, tied to a 100% payout commitment through that year. At the research date price, that equated to a 5.95% yield, higher than the comparable names in the report. A high payout can support demand for the shares, but it is not a guarantee, and the policy beyond FY27 has not been defined. The balanced conclusion is straightforward. Broadmind has a rare full-stack advisory model, a high-margin core segment, a strong balance sheet, and a notable income profile. Against that, more than half of sales come through two carriers, property timing makes reported numbers lumpy, and the stock already trades at a full forward multiple. This is educational research, not investment advice. For the full evidence and the 5-part written series, visit Uncovered Japan. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.